Okay, so today we're looking at two things. Our last week's homeworks, and then the net present value, that's NPV method of appraising investments. So quickly, let's look at the last week's homework. If we have it too, you can share it with us. Look at the question. Everybody can see the board clear. Everyone can see. Should I probably adjust it? Okay, so working capital is 20,000. Scrap value of the asset is 5,000. Good. And these are the cash flow. So year 1, 2, 3, and 4. Cash flows are as follows. Cash flows. Year 1 is 90,000. Agreed. Good. So year 1 cash flow was 90,000. Year 2, the cash flow is cash outflow of 48 negative. Year 3, the cash flow is what? Year 3 cash flow is originally there's 60,000, right? Or 90. There's 90,000. And then year 4 is 25,000. Now this is the question. Required. Calculate what? The payback and then the accounting rate of return. Let's start with the payback first. The payback period. Well, the payback period will be this. So A payback period. Good. So the first aspect will be the payback period. Payback period. Payback period. And then we look at the adjusted payback period too. Good. So payback period. Payback period. Good. As usual, year, cash flow, and your balance. Good. So year 0, year 1, year 2, then year 3, finally year 4. Good. So let's see. Year 0, 1, 2, 3, 4. Cash flow, that's the capital cost of the investment. That will be addition of the initial outlay and working capital, if any. If there's no working capital, you will leave it like that. So it will be 160,000. 160,000 with a balance of 160,000. Good. Now, with year 1, we had a cash flow of 90,000. Year 2, the cash flow will be what? 48,000. 48,000 negative. So 48,000 negative. Yes, and there was a note in the question that suggests that 30,000 will be incurred. Additional 30,000 will be incurred in year 3. Year 3. Additional 30,000 will be incurred in year 3. So when you go to year 3, originally, the funds there is what? 90,000, less the additional funds of what? 30. That will be 60,000. Good. So that's year 3 cash flow. Then year 4, we said that year 4 it will be 25,000 plus the scrap value making 30,000 plus the working capital which will be released. That's 20,000. So in all, please do the year 4. Was it 35 or 25? Good. Check from the original question. So in all, it will be 50,000. Agreed. 50,000. Now let's see. Please confirm this cash flow was The one that you took a snapshot of it, yes. If it is towards 25,000, not 35,000. Okay. Now let's see. At the end of year one, we're able to raise or recoup 90,000. So probably it will have it what? 70,000 for us to go. Okay, thank you. Now, at the end of year two, we made an additional outflow. Yes, so it will probably increase our balance. So 118,000. Then in year three, we made 60,000. So when we take it off, so that will be 118 plus 60, right? That will be 58,000. Good. So 58,000. Okay. So therefore, we still have 8,000 to pay, right? When you get to the last year, so you can tell me the payback period of this project. What is the payback period? Is it year 4 or probably year 5? What is the payback period of this project? The payback period of this project. Will it be year 4 or year 5 or year 3? Which of the years are we going to pay back? Which of the years will the project pay us back? So that is it. So that's the payback period for this particular question. So let me have your suggested solutions. Will the project be able to pay back? No, the project will not be able to pay back. Why? Because we still have some balance to clear at the end of the project life. The thing that this project will not pay back, or we are not going to recoup the capital invested. Yes, that is it. Means that the project will not pay back, and hence it must be what? Rejected. So if you're using the payback analysis, this project must be rejected. Why? Because we cannot recoup the capital invested. So take note for us. That is it. Good. So Mr. Jude, I like that. So it must be rejected due to inability of what? Insufficient cash flows to recoup the capital. Good. So that is it. Okay. Now let's proceed to the accounting rate of return for the same question. Accounting rate of return. Now the same question. Try using the adjusted payback period. It will even worsen the case. Try using the adjusted payback period. Take a discount factor of 10% if possible. Good. So let's go to the second part of the question. The second part, that's the B. Accounting rate of return. Accounting rate of return, ARR. It said that is the average profit expressed as a percentage of what? Average investment. Okay. Wow. Then I have to go back up. Year 4. Year 4. The cash flow we had 25,000 was there originally, plus the scrap value. What's the scrap value? 5,000 plus the working capital. We said working capital will be released at the end of the project life, which is 20,000. Yes, so plus 20,000. That gives us what? The 50,000. Let me do it here again. The 25,000 plus the 5,000 plus the 20,000. Good. This is the working capital. It must be released. In fact, today you will see the main reason of this. 5,000 is the scrap value. If you've not added it, you have to include it. 25,000 is the projected cash flow. projected or estimated cash flow. So putting all together, we have the 50,000. So making 30,000 plus 20, making the 50,000 cash flow. Thank you very much for getting. Now let's go to the account rate of return and you'll be fine. Account rate of return. So let's start the game. We'll start our year, then our cash flow. Then we convert the cash flow to profits. Yes, account rate of return, we need profit, not cash flow. So you have to be converted. So it must be converted. So put a year cash flow. So year 1, 2, 3, 4. Year 1 is 90,000. Year 2 is 48. Please, it's a loss. So do it like this. Good. Year 3 will be 60,000. Agreed. Which will be into bracket. The 90,000 less the 30,000. So that will probably give us 60,000, right? I like that. And a final year. Year 4. Year 4 is 25,000. Wow. Here we want profit too. So take note how we have been what? Like manipulating the figures. No, the scrap value, the 35,000 was the initial, not the amended. Good. So that is it. Now putting all this together, we will have 90 less 48 plus 60 plus 25. So putting this together, we will have, it's Madam V around me with the calculation a little. So 90 less 48 plus 60 plus 25. And that will probably give us 127,000. So putting, so this is the total cash flow. Total what? Cash flow. Good. 127,000. I like that. So 127,000. Then what do? We have to convert this cash flow to that of what? Profit. Because accounting rate of return does not use cash flow. It uses what? Profit. So let's say total depreciation. That's the depreciable amount into bracket. The original cost of the asset, that's 140,000. Wow. Less what? The 5,000. I like this question. Less 5,000. In fact, you get a decrease returned. So taking it off, what do you get? Taking it off, what do you get? You get 135,000. 135,000. So here, total loss of, what will be the loss? Yeah, to not be profit, to be what? Loss. So less 135. That's 8,000, right? Good. So there will be loss of what? 8,000, like this. And then the project life, number of years. So number of years is what? 4. Good. So 4 years. So what's the average loss? So on average, each year we get a loss of what? 2,000. And once it's giving us a loss, we shouldn't even proceed to undertake the project. Yes. Once it's giving us a loss, we shouldn't even proceed to undertake the project. So that is it. Okay, so let's see the average investment. This average investment, we saw that it's equal to the initial investment plus the scrap value, all divided by 2. If there's any working capital, you add it to it. So who can calculate the average investment for me? Yes. Okay. Oh yeah, it is you. Try. Let's try. So the average investment will be the 140,000. So average investment 140,000 plus what? Plus the 20,000. What's the square value? Square value is 5,000 plus the 5,000 all divided by 2 plus the 20,000, the working capital. Okay, I like that. Somebody have it already. But that's good news. So 107,500. Oh, so that is it. That's the average. So therefore, accounting rate of return will be this divided by this, but express the answer in negative. So negative 2,000 divided by 107,500. Yeah. Times what? 100. So it's what? 1.9%. So negative 1.9%. I'm sure that in exams, hey, I copied the wrong solution. The average investment. Now let's see. 145 divided by 2 probably give us 72,500 plus what? Plus the 20,000. Okay, so it's 92,500, right? Okay, thank you. So 92,500. So what's the average? The account rate of return. So finally, the account rate of return will be 2 divided by the answer times 100. That's 2.16. So 2.16%. But it's negative. They should even reject the project because the account rate of return is negative. Good. So basically, that was the last week assignments. This week too, remind me, by the end of the class, I'll project this week's assignments also. I will do that. Yeah. That's the holiday assignment. So now I'm done. Now let's go straight to the NPV method of appraising projects. So that is it. If you have any question, kindly ask. And today history will probably blow your mind. So fantastic. So enjoy it to the last end to get today's history. Good. Okay, that part of a bit of the board is not coming in. Yes. The account rate of return is negative 2.16%. Once it's negative, in fact, they should reject it. Good. Okay, I've not done my phone again. Let me do that. Good. I've done it again successfully. Okay. Can we move on to the next aspects? Good. So let's go to the agenda for the day. NPV, net present value method. Net present value method. Good. So you are welcome. Net present value method. Yeah. Let's welcome in. Good. So NPV method. In fact, it's the popular one the most widely method that we normally use to appraise projects. So I won't be surprised if it consistently appears in your exams, other than the other method, because it's the most widely used. So if you don't understand anything in this topic, not the almighty MPV, net present value. So let's see, let me do that one here. Net what? Present. Wow. Value, popularly known as what? MPV approach. Good. So that is it. That bit of the word is not coming properly. Let's see. Okay. Let me see if I can do something about it. Good. Popularly known as what? NPV. Net present value. Good. Now, let's just explain. Net means we are subtracting something from something. So it means that we are lessing the outflow from where? Inflow. So outflow less what? So inflow less outflow. Outflow, cash outflow. So that's the meaning of the word net. We are subtracting the operating costs and then all the capital cost too as well. So that's the meaning of the net. Net means the inflow, all the money that we are going to generate, all the receipts. Then we take what? The outflow, the small payment plus the capital sum from it. So that's the net. What about the present value? Present value means we are bringing these cash flows into today's terms, because you know that if the project life is 5 years, we are appraising the project now. And we saw last week that now means year zero. Now, year zero. That the inception of the project life. So we have to bring all the figures, all the cash flows into today's value. That's the meaning of the present value. To probably consider the time value of money, because 1,000 Ghana cedis in 5 years' time, receivable in 5 years' time, might not be the same as 1,000 Ghana cedis today. So that is it. So I should probably amend the formula. Then the basic formula for MPV is what? MPV is equal to the PV of cash inflow less what? The PV, so much, less the PV of what? Cash outflow. Good. So that's the MPV. That's the simplest formula that we can probably go by. So when they ask you MPV, it is the cash inflow, the PV of the cash inflow less the PV of the cash outflow. Good. So that is it. Now this method make use of what? Cash flow. Wow. It is a popular method in the discounted cash flow techniques. Some of the appraiser techniques use discounting approach. Others too do not use discounting, such as payback, normal payback, and account rate of return does not discount the cash flow. But MPV discount what? The cash flow. Good. So that is it. Now, very soon, we will consider how this cash flow will be determined. So probably that's the next approach or the next format. So the next step, so I'll walk you through the comprehensive format. This one is the summary of the format. There are a lot of cash inflows. There are different types of cash inflows, And likewise, there are also different type of cash outflows. So we are going to use the MPV layout to probably go through the structure or the format of the MPV, how the format look like. Yes. So that is it. Just that most of your exam question, well, the comprehensive format may not be required. Most of your exam question. Yes. Now let's see the MPV layout. So MPV layout, MPV layout. How you should probably go by your MPV, the format. So look at how we are going to do it. Now, first of all, we start with our periods, normally years. Period. So year 0, that's today now. Year 1, up to the very last year, that's year end. If you are going for 5 years, so the end of the project life. Let me do one more, at least. Up to year what? Year end. Good. That's the end of the project life. So if the project will last for 5 years, 1, 2, 3, 4, 5, 6, 7, up to 5. Wow, I've had the 5 already. Don't worry. It's part of the game. I have to end at 5. Good. So your receipts. So normally the receipt in the form of sales. So either sales, if you are going to sell tangible products, you will have what? Sales. Good. If you are going to sell products and service, you have sales. But sometimes you can also have what? Receipts. Especially if I want to enter into, let's say, education. Yes. Set up small tutorials. We won't sell. Yes, so we will receive. We're going to receive what? Public tuition fees, and then the other annual subscriptions. So that's the receipts. So it depends on the project that you are entering into. But in fact, the truth of the matter is that most of your exam questions are sales revenue, sales. A few of them talks about the receipts. Good. So much. Year 0, no, you won't have a receipt in year 0. Year 2, and then up to the final one. Then your variable costs. Variable what? Costs. We saw this under the cost calculation. So for those who have not gone through that, please go through. Other than that, probably be seeing stars. Let me write it big here so that you can see it clearly. So sales revenue or the receipts. Good. Variable costs. Variable costs. Good. Now this variable cost, we did that under the cost classification. So if you've not gone through, I will put the link to that video under the comment section or under the description section on the YouTube, so that you just tap on it and it will lead you to cost calculation. Yes, under the question 8 of the budget. Now the variable cost may comprise of what? Direct material, direct labor, direct expense, and production overheads. That's the direct, or that's the variable cost. Good. Summing all together, we have the variable costs. Good. Sometimes, if you are lucky, the examiner will just give it to you straightforward. The variable cost will be 2 Ghana cedi per game, 2 cedis per unit. Straightforward. So you find the total, you bring it here, you subtract, and then you also subtract. Good. From the variable cost, you go straight. Probably. We know that Sales less variable cost will give us what? Contribution. Let me do this, because sometimes the question may give you the contribution straightforward. Then meaning you have to start from that section. So I'll present to the alternative to you. So you have contribution. Good. So sales less the variable cost will probably give us the contribution, so much, so much, so much. Then what do? Then you bring your incremental fixed cost. Incremental what? Fixed cost. Have you seen the word I use? Incremental fixed cost. We will explain that. So incremental fixed cost must be subtracted. Must be subtracted so that you get your what? Finally, your profit. So this is the profit. Your profit. Yes, so that's it. Incremental fixed cost and then your profit. Good. Sometimes too, we don't need to show the contribution, right? So we can probably continue straight forward. That's the alternative approach. How we get it. So the contribution section will not be probably shown. So something like this. So we will not show the contribution. We just go straight forward. So take note. Some of the questions, the examiner will give you the contribution already. Yes, I did this to just illustrate to you. And let me go back to my normal section. I want to keep it short. So from variable costs, you go to what? Incremental fixed costs. Incremental fixed costs. Good. You subtract that one too. If there's any marketing cost that will be incurred, you probably bring all those ones. Good. Then you get your profit nicely. So that is what? Profit. And don't forget, as soon as you bring the profits, if there's tax in the question, the next aspect is what? Tax. Because the project that we are going to enter into, the host country may tax us. So it's subject to what? Tax. So now let's see. So tax. Here, let the examiner tell you, if the rate is 25%, you just take 25% of this. And there are two ways in which tax cash flow may probably occur, or two ways of paying tax. One, the common one, tax is being paid 1 year in arrears. Tax will be paid what? 1 year in arrears. That's the common one. And then the alternative, tax is being paid in the year in which profit what? Arise. Good. So in that situation, let me pick the one after the other. So if tax is being paid in the same year, it means that year one tax will be paid in when? Year one. So when I extract the percentage, I'll bring it here. Year two tax will be paid in year two, and year three too will be paid in year three, up to the end of the project life. Good. That is the tax. That is the one way. That's if tax is being paid in the same year in which profits arise. The alternative, or the most common exams one, will be tax is being paid 1 year in arrears. It means that year one tax will be paid in arrears. So it will be paid in when? Year two. So you find your 25% on year one profits, but don't put it in year one because they are not going to pay it in year one. Yes. Because timing of cash flow is very important. Timing of what? Cash flow. Yes. Not, wow, I like this. Timing of the cash flow, not the occurrence of the cash flow. Wow. What's the difference? Not the occurrence though. Even though the tax we are going to incur it in year one, but the timing of the payment is in year two. So wherever we are going to pay it, that's where you have to place it, not where it occurred. This is cash flow. So it must be recorded as and when cash is being paid or received, that particular period. So even if you are going to incur it, let's say 2 years before the payment, you have to record it after. or when the payment is being made. So take note, most of the exam questions like that. And then most of examiners have capitalized on this and the step in exam questions. Good. So that is it. So now let's continue. So when exactly they are going to pay it, that's where you have to what? Record it to. So they've incurred it in year 1, but they are not going to pay. They'll pay it in year what? 2. So tax is paid 1 year in arrears. Year 1 tax will be paid in year 2. You just find your percentage on year 1 profit. Just find the percentage on year 1 profit. Push it to year 2. Find the percentage of year 2 profit. Push it to year 3. In that instant, you will have an extra year because of the tax plus 1 year. So if it's year 5, you get year 6. It's for the tax purposes because the last year tax will be paid in what? The following year of the project. If the project will last for 1, 2, 3, 4, and 5 years, because of tax being paid 1 year in arrears, go extra. Do what? Extra. Add year 6 to it because year 1 will be paid in year 2, year 2 will be paid in year 3, year 3 will be paid in year 4, and year 4 will be paid in year 5, and year 5 will be paid in where? Year 6. So you have to add extra if tax is being paid 1 year in arrears. Please, I hope you get this. Yes. Okay, that's fine. Now, what if the question is silent? When the question is silent, any of them that you use is correct. But please choose the easiest one. Like make things look okay. Don't complicate matters for yourself in exams. So, like myself, I would choose taxes paid in the same year. Oh yes. I don't want any extra year. So that is it. So let me bring the tax here. I'm done with the tax. Good. So this is how we probably get the tax cash flows. So take note for us and then you'll be fine. Okay, right from tax. Then you say tax savings on capital allowance. Tax savings on capital allowance. Tax savings on capital allowance. That one we do working. So when I start, in fact, after the format, I'll pick each of the item one after the other and talk about it. So I'll talk about it. One of the topical issue. Tax saved on capital allowance. You know, the tax authority will not allow you to publicly claim your depreciation, will not allow you to include depreciation as an expense. In place of that, they will probably give you capital allowance and then it will save you from paying some tax. So that is it. And it must move in line with the tax cash flow. If you pay your tax 1 year in arrears, any enjoyment on tax 2 must also be enjoyed 1 year in arrears. If you pay in the same year, you have to enjoy it in the same year too. Good. So that is it. Then working capital. Wow. Yeah, we take our time and do justice to it. Working capital. Now with working capital, you have to start from year 0. That one start from year 0. Where's year 0? Year 0, year 0. Good, year 0 is here. So I'll talk about them on their own. So working capital, and last year you have to recoup it. So for working capital and tax saved, I'll talk about them after the format. So we will explain them. Now, this tax save, let me talk about this more. This tax save is the allowances or the capital allowance that the tax authorities granted onto the organization. It will save you from paying tax. So that's all. So that's why we are probably adding. So it's again or a plus to us because it will probably absorb some of the tax burdens. So we are adding it back. So these are the tax saved. So it's a plus. You have to probably add it. It's an inflow to us. So we are adding it. Then working capital. We said that working capital is the funds or the resources that you use to run the business on daily basis. Yes, so it has some 3 rules. We will say that and then you have to add it. You have to incorporate it. Please, it is not compulsory by force. For example, not to give you all this in one question. No. This one is a format. So it contains all of them. In fact, we have even summarized it. Yes. So some of the exam questions, these two will not be there. Yes, so don't need to worry. Good. Now for working capital, then we're almost getting to the end of the game. What do you do again? You write the cost of investments. So probably, so costs of investment slash the scrap value slash your scrap value. So the cost of investment, the initial cost of investment, you bring it here. So in that case, in the previous example, here will be 140, right? Because that's the initial cost of investment. Put it in brackets. Why? Because an outflow, we are paying. All payments should be in brackets. All receipts, positive. Good. The working capital will be 20 from the question. Good. And you put it there. So nice. Now, if there's any scrap value, send it to the last year. The scrap value to be positive there. Good. That's the scrap value to be positive there. To be positive. So if there's no scrap value, you leave it like that. So whilst the cost of investment is negative at year 0 because it must be provided now. If you're going to start a project, normally you need the initial outlay or the capital investment at the inception or at the start of the project life, which is year 0. At the start of project life is what? Year 0. Unless otherwise stated. It can be like this. I need 10,000 cedis to probably start my project. That 10,000 cedis, okay, I can provide all the 10,000 cedis now. That's year 0. Or I will spread it. I will provide 80% now. That's 8,000. And then I'll provide the remaining 2,000 at the end of the second year. So year 2. Good. Unless otherwise stated. So the examiner can give you the terms, the payment, or how the capital will be what? Raised. Yes. But if they don't tell you any such information, then the capital sum should be raised at year 0. That's now, at the start of the project life. Thank you very much. Okay. Now let's continue the game. So right after all this, you just sum all up. Then what do? You what we call cash flow. We call it net cash flow. Wow. Net what? Cash flow. So much will be negative. Good. Net cash flow. How do you get a net cash flow? It's a summation right from the profit arena up to the end. So you sum them up year by year. Then you get your net cash flow. In fact, have you seen the cash flow that I gave in a question? The one we just solved. Account rate of 10 payback period, the cash flow. This is the procedure, the process that we went through to arrive at the cash flow. So any cash flow given to you, in exams, this is how probably they went through to get it. Good. Discount factor. Maybe the percentage, the rate, X percent, maybe 10%. Here, that's the cost of capital. And it is not our duty to generate that or focus that. Probably the examiner will give it to us. Yes, under the management section. But under the finance section, no. Probably you may also require to compute it yourself. But in your case, the examiner will give it to you. So the discount factor will be given to you. That's the cost of capital. How much it costs us to probably secure funds to finance the projects. So that is it. And usually quoted in percentage, which is the weighted average cost of capital, either the WACC, depending on the financing method that you are going to use for the projects. Good. And it must include project specific risks. Yes. So that is it. Now the cost of capital, please leave it in 3 decimal places. How do you get the discount factor? 1, if it is 10%, you say 1 Let's do it here. If it is 10%, you say 1/1 plus, convert it to decimal. So that will give us 0.1. If in year 0, put 0 there. Year 0 will always be what? 1. Because if you put 0 here, any number raised to the power 0 is what? The number itself. That will be 1. 1 divided by 1 is 1. So here always it will be 1. Yes. Why? The reason is this. 1 Ghana cedi today is the same as 1 Ghana cedis. Oh yes. 1 Ghana cedi today is the same as what? 1 Ghana cedi. Unlike, wow. Good. Unlike changing value, if the money time changes, meaning the value of money will probably change. So for year 0 will always be what? To always be 1, because time have not probably changed. So let's see how the discount factor will be probably determined. So the factor, if at year probably 1, you put 1 there, put the answer down. If at year 2, you put 2 there up to the end of it, and then you fill it. So discount factor, maybe 10%. So much, so much, so much, so much. How we get that? So that's the discount factor. Then you underline it again. This is the cash flow. This is the discount factor. So what will be the present value? So PV of what? Cash flows. So this multiplied by this. And then you put the answer here. You put the answer here. And that's the end of the game. Now, when you are done, this is the net cash outflow. And these are the net cash inflows. Present value of the net cash inflows. Present value of the net cash outflow. Then what do? You sum it up. So negative plus plus plus. And finally, the NPV is equal to, so NPV, that's the final answer. You put it there, put it there. So that's this negative plus plus plus. If there's any of them negative, take it off, then you are done. So this is the format and this is the layout of the MPV. Like I said, good. The working capital for last year, yes, it's always positive. You will explain that. Working capital for last year is positive. We will probably explain that. Yes, it's positive. It's positive. We will explain that. Good. Thank you. Let's let your question flow. Analyze the format. Yes, and like I said, it's not compulsory for them to probably put all this in one question. No. For your case, no. If it's a pure finance question, that one there, they can even do extra. Yes, a pure finance question, this is not enough. They will do what? Extra. But for your syllabus, management accounting section, for management accounting section, they don't need extra of this. So all this might not even be there at a go or probably at once. So in this year, we are examining only up to this session. Okay, next year we are examining from here to here. Next year we are examining there. Now when you get it, there are some rules, because not every sales you can bring it here. Not every variable cost you can bring here. Not every fixed cost that you can bring here. Not every, in fact, there are rules governing the items, and if you get that one, no question will probably beat you. And that's what I want you to get from me. That is very crucial. So you're going to do it every year. We can't start question with that item. Yes.
Okay, so we call it relevant cash flow. These are the cash flows. These are the relevant. There are rules guiding the relevant cash flow. How you are going to select the cash flow. Is there any sale? Every sales or cost? No. So can I dust the format? So that is it. Very lengthy but summarized. Good. Okay. So let me continue with the relevant cash flow. If you get the format correct. Good. Okay. So relevant cash flows. Relevant cash flow, that's the next topic. Relevant what? Cash flow. Cash flow. It means that before you can record item in the MPV layout, it must pass this text, this condition, this criteria. Yes. What are the cash flows that are what? Probably relevant to your MPV calculation? The cash flow that are what? Relevant. That need to be what? Recorded. It means that some of the cash flows are what? Irrelevant too. So in exams, we are going to mix it. We will give you relevant cash flow versus plus what? Irrelevant cash flow. So like I said, overflow information is allowed. Yes, we mix it for you. So it's just a matter of you probably taking what you need to answer the question. So the first one states that it must be of what? Cash flow. The relevant cash flow must be, so the relevant cash flow must be one. Must be cash flow. Oh, must be in the form of what? Cash flow. Cash flow. It means that it must result to what? Payment. It must be cash flow. It means non-cash item must be ignored. Non-cash item should be ignored. Non-cash item. Non-cash items or non-cash transactions. Non-cash items must be ignored. How we get that? Okay. Must be ignored. Good. What are the examples of non-cash item? As usual, we've done non-cash item and the cash flow. The same non-cash item here. Examples are what? Depreciation. That's the only ones that we normally use to confuse. Depreciation. So depreciation. Have you seen the format? There was no depreciation inside. We did not include depreciation. The format that we did, there was no depreciation in it. We didn't include any depreciation. So take note. So if depreciation has been included, what do? We reverse it. Because depreciation, we don't cater for depreciation under the cash flow. Why? Because it does not involve like movement of cash. Depreciation is a mere provision. It's a mere provision. It's an allowance, not a cash flow. Yes. Good. So that is it. Though it's monetary. Monetary. So here, that's the only thing that we need to worry you. Non-cash items should be ignored. Example. Sister, thank you asset. Brother, thank you asset should be ignored. Good. If you are not going to pay for it, please don't include it. If you are not going to pay for any item, don't include it. If you are not going to pay, don't. And the situation you don't pay, you allow, you provide. Good. That's the provision. Second, it must be in what? Future. Wow, I like that. Future. It must be future. The relevant cash flow must be in future. Must be in future or must occur in future. It means that past and sunk costs must be ignored. Wow. must be what? Ignored. Each and every stage and what we use to worry. Under here we use depreciation. Over here we're going to use past and sunk cost. So you should know examples of past and sunk cost. Example of past and sunk cost, they are: one, research cost. Research and feasibility studies. So research example include what? Research costs, feasibility studies, or any cost that which has been incurred already. Cost that you've already incurred it. For instance, we are now year 0. We are now analyzing whether we should accept the project or not. The project will last for, let's say, 3 years, 2 and 1. Now, any cost that we have already incurred before analyzing this, it must not be included. Why? Because whether or not we accept the project, we have already incurred it. That makes it a sunk cost. Sunk cost is the cost which has been already incurred, but future decisions may not change that. Cost that you've already incurred it and no decision can change it. That's the sunk cost. Good. So that is it. Now, sometimes you incur those costs in order for you to be able to forecast the cash flows. If you want to forecast the cash flow, you conduct what? Market research and market survey. All these market analysis and market survey will come with what? Cost. When they come with cost, you pay them. And then before you calculate the MPV, and such cost should not be included, because whether you reject the project or you accept the project, you have already incurred it. Good. So such cost, either we call it committed cost. You've committed yourself. Whether you finish it or not, you've already paid it. Yes. So such cost should be ignored. And the one that examiners use is the research cost and feasibility studies. Research and feasibility studies. Good. Third one. In fact, if I understand this one, but I'm done. I should not even talk plenty. I'm done, yes. Because the cash flow they are going to give it to you, you make sure that the depreciation will be inside. Make sure the research cost is inside. Make sure that feasibility cost is inside. Yes, mix it. The last one, the relevant cash flow must be incremental. Must be what? Incremental. Wow, I like that. Must be incremental or incidental. Incremental or incidental or directly related to what? The project. So that's the incremental. It must be incremental. Incremental in the sense that it must be directly, solely traceable to what? That project. Good. So it must be incremental to the project. Incremental to the project. It's like, yeah, assuming that, let me probably do some short quiz here. Very short one. Don't take. It will probably explain the incremental well. Assuming that our sales revenue, maybe for 2016, with the projects, taking into consideration the project, the sales revenue is 200,000. Without the project, sales revenue is what? It's 80,000. Good. Now tell me, what sales revenue? What will be the sales revenue? What will be the revenue that we are going to use to calculate the MPV in 2016? Will I use the 200 or the 80? Tell us. So with the project, without the project, our sales revenue is 80. If you should add the details of the project, the sales revenue is what? 200. So now tell me, everybody should probably type the sales revenue that we should use for the project. So tell me the sales revenue that is what? Directly traceable or attributable to the project. So the sales revenue, which is what directly attributable to the project or which is incremental to the project, is what? 200. I like that. 200. I like that. So here we use what? 200 because with the project is 200. I like that. In fact, any answer is what? Valid until the final marking scheme is reviewed. So let the answers flows. Yes. I like that. I like that. In fact, I like that. Yes. Let me see your answer. I'll check everybody's own. Yes. I'll start mentioning names. Even though your own is not here, you are typing just, it won't take time. So please, I'm begging you. Let me have your solution. Yes, let me have. So far, I received only 2 people. But we are over 10. Okay, waiting. Okay, let me start. Probably mention small names. Waiting. What will be the directly attributable sales for the project? With the project, the company sales revenue is what? 200 Ghana. Without the project, the company is getting 80 Ghana cedis. So tell me, what will be the specific project sale or the incremental sales to that project? Please let your answers flow. I want to receive them. Yes. I want to know whether you are following. So kindly type your answers. And don't forget the rule. Any answer is valid until the final marking scheme is reviewed. I like that. I like that. Yes, some have already given me double answers. So I'll take the first one. Some have already given me double answers. I like that. Double answers. I like that. Good. Good. Wait, we are more than 4. Yeah. Where's my and yes, we are more than 5. Waiting. Okay. More than 5. More than 5. More than 5. We are more than 6. Okay. So I think you had it correct. So the sales revenue incidental to the project to be what? Is 120 Ghana. Oh yes. Because with the projects, you are getting 200. Without the project, you are getting 80. So the incremental sales revenue to that of the project is what? 120. Don't forget that here we are appraising the project. We are not appraising the company as a whole. If we are appraising the company as a whole, fine, we'll consider that. We are appraising only the project. Good. So we have to use cash flows relevant or incidental to the project. So thank you for all your answers. Yes. And then you had it right. Thank you. Now here, what we are going to use to worry is this. General overheads or general fixed costs must be what? Ignored. Okay. I'll do that. With and without. Here was 80 and here was 200, and that's the sales. Incremental means we should pick items that are solely or directly relating to what? The project. We should not mix other details to that of the project details. No. Incremental means we have to pick cash flows that are only attributable to that project so that we can value that project well. We shouldn't mix the project details with our company's information. Yes, that's the incremental. And it's very topical issue because sometimes you find it very difficult to separate the companies. Wow. Good. Now, this is very topical issue because sometimes you find it difficult to separate the cash flows that are coming from the company to that of the projects. So here, We are saying that make a clear distinction and select only cash flow which resulted from where? From the project. Don't add the company's details to it. No. So that's the incremental. It must be incidental or directly related to the project. Directly related to the project. So that is it. Directly related to what? The project. I hope you get it. So over here, the company sales revenue overall is 200, but plus the project too. But without the project is what? 80. So the one that's solely, or the one that is coming from the project is what? It's 120. Before they arrive at what? They arrive at the 200. So here in the MPV calculation, we have to use 200 Ghana cedis. Good. Please, here there, even if you don't see these two, for this one, you see it there, because it's a very topical issue. Highly examinable, incremental cash flows. Now, the cash flows that we are going to use to probably disturb you a little in exams. Yeah, one, general overheads must be ignored and general fixed costs. So let me start. One, general fixed cost should be ignored. So general fixed cost, should be ignored. So this must be ignored. General fixed cost. If you want to pick any fixed cost, you have to pick the fixed cost, which is what? Incremental. So that's why we call it incremental fixed cost in the MPV calculation. We didn't write probably fixed cost. We wrote what? Incremental fixed cost, meaning it is solely to the project. It is directly relating to the project. It is incremental to the project. Now, incremental means that cost or that cash flow will arise if you go in for the project. That's the meaning of incremental. If you go in for the project, that cash flow will arise. It means that cash flow is what? Incremental. Good. Some of the cash flow, whether you go in for the project or not, it will surely come. And such cash flows, we don't need them. Example of such cash flow is what? General fixed cost. Your rent, the office premises. Whether you want to take the project or not, if you already committed yourself, you are paying your rent regularly, on regular basis. So you should not add what? Your general rent payment to that of the project. No. Don't even apportion it. But if probably you are occupying 3 rooms because of the project, you now need 5 rooms. So it means that there's 2 rooms. There will be 2 rooms extra. You need 2 extra rooms, right? That becomes incremental. It is directly to the project because your normal capacity is 3, but now you need 5 because of the project. So any amount that you pay for the extra 2 rooms, it must be added. That's not the general. It is what? Incremental. It is incidental. So that is it. 2, apportioned overheads must be ignored. We don't apportion any overheads. So no what? Apportionment of overheads. No apportionment. Apportionment of overheads. Or overhead apportionment must be ignored. No apportionment of overheads. Good. Let's put it this way. Overhead apportionment must be ignored. Overhead apportioned or apportioned overhead must be what? Ignored. Like you are saying this. Your room, if you occupy, let's say 3, and you are paying rent of, let's say, 200,000 a month, and you are saying, okay, now when I take, or when I accept the project, when I go in for the project, I have to share these 200 Ghana cedis between the period cost, the company's own result, and the project cost. Good. Now, when you do this, you are going to apportion these 200 Ghana between the project, the period, your company's result, and the project, which is not good. So apportionment of overhead should be what? Ignored. All apportioned overhead must be ignored. Apportioned overhead must be ignored. Overhead apportioned must be ignored. Any overhead that you share, if you cannot determine this directly, please don't share. Good. So that is it. Please, it's very important and vital. On that note, we will pick our first illustration question. If you have any question, kindly ask. If not, we will pick our first illustration question. So this is how it will be. So question time. So let me pick your questions before I'll solve my first illustration on MPV. That will be November 2017. Nope. We will do, okay, yes, we do November 2017. Yes, true. They will surely come. Yes, they know they will surely come. I'll for them to. Okay. So let's see our first question. Good. So let's see. The question is ready. That is ICA November 2017. ICA November. Hey, which one have I opened? In trouble. I think it's a different question I've opened. I think it's a different question. Now let's see if the question is in. Yes, the question is in. So I will solve the why is this thing freezing? Sorry, the machine say will not allow me to operate. Okay, yeah, now it has started moving. I'll solve this question, but don't be scared though. Not all the questions are for you. Yes, I'll select your own for you. Question. We are doing question hexane. No, not hexane. This no. Is it Papa Jasco? Yes, I think it's Ajasco. Yes, Papa Ajasco. I think that's the name of the question. Yehuwa. No. No. Yes, Ajasco. Ajasco Limited. That's question 11. That's what we are doing now. We are doing Ajasco, question 11. Okay, now let's see. Calculate required. Calculate the net present value of the proposed investment and comment on your findings, meaning should they accept it? The acceptance criteria will be accept the project with positive MPV. If the MPV is positive, accept it. If the MPV is negative, reject it. That's a single project. But if you go to multiple projects, with multiple projects, accept project with the highest MPV. If you have potential investment, you are thinking of which one are you going to probably, and I take or accept, go in for the one that give you the highest what MPV. Probably it will increase the shareholders' wealth or shareholders' value. The one that will best increase the shareholders' value. That's it. Okay, now let's start reading the question. Ajasco Limited, a software company. This ICA November 2017 past question. Yes. Ajasco Limited, management accounting. A software company has developed a new game called Lando. Lando, which it plans to launch in the near future. Sales volumes, production volumes, and selling prices for Lando over its 4-year life are expected to be as follows. Good. So sales and production, these are units, please. Sales and production what? Units. So year 1, they are going to sell 150,000 units of Lando. Year 2, 70,000 of what? Lando. Year 3, 60,000 and 60 for year 4. Selling price is what? 25. Here the selling price is not constant. Your examiner have a constant selling price. Your selling price are different. So to get a sales revenue, what do? You multiply respectively. Then you get it. Financial information on Lando for the first year of production is as follows. Direct material cost 5.4 per game. Other variable costs is 6 per game. So what will be the total variable cost? Material is what? 5.4. Then other variable production cost is what? 6. So in all, the variable cost of production is 11.4 per game. Agreed. Then you'll be multiplying it by the production units. Sales and production units. To get it. Okay. Now, fixed cost is 4 cedi per game. In fact, before you can bring fixed cost in your MPV calculation, let's do this. Fixed cost, we said that general fixed cost must be ignored. The only fixed cost that we want is what? Good. Can't see the question. Okay. I'll probably increase. Is it okay now? Is it okay now? The question. Okay. I think I'll do that. Now, the fixed cost that we want is incremental fixed cost. Is the one that will be incurred, not already incurred. Will be incurred. So the only fixed cost that we want is the fixed cost that they will incur extra, the extra fixed cost, the incremental fixed cost. So in exams, when they quote fixed costs, make sure that it is the extra one that they will incur when they accept the project, or it is what? The fixed cost that they will incur will be. So you are going to use the word will be, will be incurred, not already incurred. So take note. Will be incurred, not already incurred. I think someone is having a question. Let's pick the question up. Good. Now let's continue the game. So we said that the first cost that you have to bring, they have to tell us that it's incremental or will be incurred, not the general one, not already incurred cost or fixed cost. No. Now let's see. Advertising costs to stimulate demand are expected to be what? 650 in the first year of production. So, and 100,000 in the second year of production. No advertising costs are expected in the third and fourth year of production. Now, fixed costs represent incremental cash fixed production overhead. Please, have we seen it that they're explaining it, not just fixed cost too? Because if they should just say the general fixed cost, we are going to probably ignore it. Fixed costs represent incremental cash fixed production overheads. Good. Lando will be produced on a new production machine costing 800,000. That's the initial capital, or that's the initial outlay. That's the initial investment. Good. That's the cost of investment. All of these are the same. If they don't tell us anything, it will be incurred what? Now. Because if you want to start maybe a taxi business, you need a vehicle now before you start the business. You won't start the business and later on you buy a vehicle. No, you have to get a vehicle. Whether you are going to buy it or rent it, you have to get a vehicle at exception. So that's how it will probably translate. Good. Although this production machine is expected to have a useful life of 10 years, the government have started their game. 10 years. Government legislation allows Ajasco to claim the capital cost of machine against the manufacturer of a single product. Capital allowance. Of a single product. Capital allowance will therefore be claimed on straight line basis over the 4 years. So I'll talk about it when we start it. Now, it can't go down. Ajasco Limited pay tax on profit at the rate of what? 30% per annum, and tax liabilities are settled in the year in which they arise. So the same year, not 1 year in arrears. How we get it? So it means that the tax, we will calculate it and put it at the same year. Now it continues to say that Ajasco Limited uses an after-tax discount rate, that is discount factor of what? 10% when appraising new capital investment. So that's the end of the game. Kindly screenshot this so that you have probably a copy of it for the meantime. You can screenshot it. This is an important section. Yes, you can screenshot this. Okay, you can screenshot this section in the meantime. Yes. Then we start the game. We will start the game. Okay. Now let's see. Now let's go to the board. Let's go to the board. Let's go to the board. So we are going to set a tone. So here, there were no issue of the relevant cash flows in here. Nothing will be ignored. Sorry. Sorry. Good. Now let's see how we can do this. We are going to be fast here. So how many years? 4 years, eh? Good. So you start by saying MPV layout. MPV layout. So kindly give me figures and then numbers when the need arise. Okay, so NPV, probably. Let me do it here. NPV layout. We start year 0, year 1, year 2, year 3, finally year 4. Hey, this thing will it go there? Can see this thing will it go there? Let me increase the space here. Let me increase the space here. Okay, so probably year 0, that's now, today. Year 1, year 2, year 3, and then finally year 4. Okay, so I'll start sales. What's the sales revenue? Is the selling price times the unit. So what's the sales revenue? Good. So now let's go and then pick the sales revenue. The sales revenue. So the sales revenue will be, yes, you can capture this screen if you can do that. Those with PC can also do that. Those with phones can also do that. Good. Now sales revenue will be 150,000 by 25, 70 by 24, 60 by 23, and 60 by 22. Agreed. So doing that, what do we get? 150 by 25. Now realize that the answers will be in thousands, right? The answers will be in thousands. So probably we can raise thousands. Can raise 3 zeros on top. We are working 3 zeros. So we will multiply it by 150. So therefore, it just be 150 Ghana times 25. 150 unit times 25. So 150 times 25. So that's 3750. 3750. So 37, no, that'll be year what? Year 1. 3750. Good. I hope you get that. Still the question. Well, I'll make them available for you. What about year 2? What about year 2? What about year 2? Who can probably do the year 2 own for me? Year 2. Year 2. Let me summarize the question here. The production unit was 150, 70, 60, 60. Yeah, 1, 2, 3, and 4. Selling price is 25, 24, 23, 22. Agreed. That was the selling price. So we multiply. What again? What again do we have in the question? Material cost is 4.5, 5.4, and then the fixed cost. So material cost is equal to 5.4. Other variable cost is equal to 6. And fixed cost is what? It's 4 cedis per game. Good. So that's it. Okay, kindly help me with the calculation. Let me know if you get it. Let me know if you get it. Good, 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 good. Wow. Wow. Still have issues with the questions. Good. 1,680 for year 2. So we'll be multiplying, right? So 150 by 25, 70 by 24, and then that order. So now let the answers flow. Let the answers flow. So 1680. Good. What again? Year 3. Year 3 will be 60 by 23. So 60 by 23. That's 1380. 1380. What about year 4? Year 4 will be 60 by 22. That's 1320. Kindly let me know if you are getting it. If not, let me please and confirm the figure. Make sure that the figures are correct to you after your calculation. Good. So that is it. I'll go straight to the variable cost. Variable cost. The variable cost too will be, you add the 5.4 plus that of the 6, making 11.4. So therefore, the variable cost is equal to the 5.4 plus 6 series, making 11.4. So you multiply it by the units respectively. Good. And kindly give me the answers if you have them. Please, you can start from the back. Somebody can start from year 4, other person will start from year 2, year 3, and then within some few minutes, we are done. Good. Please, I hope you are following. I want to continue. Let me know if you're following before I continue. Yeah. Hello. Kindly let me hear from you. Good, 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 good. Okay. Okay, good. Thank you. We can continue. Good, 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 good. Okay. Now the variable cost, they are saying this, so you can probably do workings somewhere. So variable cost, probably calculation. Material cost is what? 5.4 Ghana cedis. Other variable cost is 6 cedis. Putting this together will be what? 11.4 per unit. You don't need to do them individually. Material, no, not at all. Don't do them individually. Just sum them up. Get one variable cost per unit. And just be multiplying by the units. So 11.4 times 150 for the first one. So 11.4 times 150. 1710. Good. So that is it. 1710. Good. So 1710. Put this in the bracket. What about year 2? And somebody too is trying the year 4 and year 3. Then we are done. Good. So it will be 11.4 times what? 70. And I'll give us 798, right? Good. So 798. Please, everybody must get it too. Everybody must get it too. Good. So that is it. Year 3, 684. I like that. I like that. 684. Then you put it in bracket. All costs should be in bracket. That means it's an outflow. Then what about year 4? 11.4 times 60. It should be the same. Yes. So 684 in brackets. Do you have incremental fixed cost in the question? In fact, good. Do you have incremental fixed cost in the question? Yes, there's incremental fixed cost of what? 4 Ghana cedis per game. And here it was a bit challenging, please. But this question, the area of trick or focus was on the fixed cost. Yes. So let's write incremental fixed cost. Incremental what? Fixed cost. Into bracket, it will be 4 cedis per game, right? Good. So it will be incremental fixed cost will be 4 Ghana cedis per game. So if it is 4 cedi per game, then year 1 it will be what? 150 times 150 Ghana cedis. And that will give us 600, right? What about year 2? So it will be 4 cedi times 150. Please, everybody have to understand this section because it is, or it was the troublesome part of the question. So what will be the answer for year 1? 600, right? But I already have it here. What about year 2? Who can tell me year 2? The year 2. Who will tell me year 2? And year 4? In fact, all the years. The one that you can get, let me know. Wow. Okay. Now, fixed cost is fixed within a relevant range. So if you are getting 280, so you multiply the 4 by what? 70, eh? It means that you have make it variable cost. So yes, if make it variable cost. You have make it what? Variable cost. You have make it variable cost. Meanwhile, it's a fixed cost. So the truth of the matter is that if the fixed cost is 600 for the first year, it will continue to be fixed for all the other years. In fact, if the fixed cost is 600 Ghana cedis for the first year, for year 1, then year 2 is fixed. 600 year 3 fixed. 600 year 4 fixed. One is the fixed cost. Good, 600. Alternatively, you realize that here this is the highest unit. We said fixed cost. Wow, so we said that fixed cost is fixed. Yes. Yes. Now, fixed cost is what? Fixed within a relevant range. Here you can see that the company's relevant range is what? 0 units up to 150 units. So between this, the fixed cost will be fixed. It will not increase. But if you multiply it by 4, if you multiply it by the 70, in order to arrive at the 280, it means that you have make it what? Variable. You have varied it. And fixed cost must be fixed. Yes. Fixed cost must be what? Fixed in the relevant range. Fixed cost is what? Fixed in the relevant range. Good. So take notes. Fixed cost is what? Fixed in a relevant range. Yeah, alternatively, someone can also find the average unit. Average, you find the average. You add all this and divide by the number. When you get the average unit, then you multiply by it, all of them two will be correct. That's the normal. But the best way to do it is to get the fixed cost for year 1, and it will be the same for year 2, year 3, year 4. Why? Because they say fixed cost. They didn't say variable cost. So good. So just that the confusing part is that they say fixed cost per unit for year 1. And once it's fixed, it's going to be the same throughout. So take note. In fact, that year, that question, or this question, this was the troublesome part of the question. So thank you. Now let's go to the profits. Kindly, if you get it, find a profit for me. But if you don't get the incremental fixed cost too, I will still probably go back for you. So let me know. If you don't get it, you can probably let me know. Now, what's the profit? If you get it too, then give me the profit. What's the profit for year one? How do you get a profit? Sales revenue, less the variable cost, less incremental cost. Is there any other cost in the question before we close the chapter? Yes, you have to ask. Is there any other cost in the question? Is there any other costs in the question? Let's see. I get there is. So, is there any other cost in the question? Yes. So advertising cost to stimulate demand. Oh yes, advertising. 650,000 in the first year of production and 100,000 in the second year. Good. So advertising cost. Advertising cost 650 in the first year of production to stimulate what? Demand, and 100,000 in the second year, and none in the what? None in year 3 and 4. So dash dash. So now finally, what is the profit? Then we are done. I guess we have exhausted all the items. Okay. So kindly calculate the profit for me. So sales revenue less all the costs. All the costs. So profits. So 790. I like that. So 790. What again? And then someone to also try year 3, year 2 for us, so that we can finish quickly. Let me do the year 4. 1320 less 684 less 600. So that's 36 for the last year. 36. 182 for what? For year 2. I like that. Just do the calculation. Oh. Please join the call. 272. I'm getting 2 different answers for year 2. Someone said 272. I don't know who said 182. Difference of 10. So for year 2, I need a confirmation, a third answer. Year 2, what do you get in year 3? Year 2 is 182. Okay, so 182. Okay, so confirmed. And then year 3, 1380 less 600 less 684. That's 96 and good. Year 3. Good, so that's the profit. Now let's go to tax. Let's go to tax. Let's go to tax. Tax is at the rate of 30%. And we pay tax in the same year. You pay tax what? In the same year. So let's see. So what will be the tax expense? The tax expense. For year 1, you multiply by 30%. So the tax expense will be 0.3 times 790. That's 237. And tax is being paid the same year. So I write it here, 237, the same year in brackets. What will be year 2 tax? Kindly get me the tax. Year 2 is 54.6. So 54.6. Year 3 is what? 96 times 0.3. That's 28.8. So 28.8. Year 4, 36 times 0.3. 10.8. Agreed. So that is it. So that's the tax expense. Okay. So I hope you get it. Good. Now let's move on. Right from the income tax expense, you go to your tax saves on capital allowance. Tax saved on capital allowance. Now, let me take the time and explain it into detail a bit. Now, when you talk about tax saved on capital allowance, tax saved on capital allowance, it's equal to the tax rate multiplying by what? The capital allowance. You are saying that the tax authorities will not allow depreciation. They will disallow it. In place of that, they will give you what you call capital allowance, or you can also say that taxman's depreciation is called capital allowance. Good. So it will probably save us from paying tax. The amount of tax that it will save us, that's what you call tax saved on capital allowance. So probably it will be what? The capital allowance itself times the tax rate. That's all. So you probably tell the examiner that tax saved is equal to what? The capital allowance times the tax rate. That's all. Capital allowance means taxman's depreciation. That's the meaning of what? Capital allowance. Taxman's depreciation. How the tax authority calculates what? Depreciation. Now, so what you do is this. You put a year here, and then you put your capital allowance and tax saved in a nice table. Let's see how the table look like. Year one. In fact, if you're using the reducing balance method, don't even worry yourself. Please, which session? Which session? The capital allowance. Yes. Capital allowance. Let's assume that depreciation. We did not bring depreciation here because it's non-cash item. And then the tax authority too don't like it. Instead of that, they will grant us what we call capital allowance. I personally call it taxman's depreciation. Yes, capital allowance. Because how companies calculate it is different company to company. If I should call, let's say, if I should call 100 accountants or 100 company, they will give me different depreciation value on the same asset too. They'll give me different depreciation. But with the tax authority, the same assets have the same rate. Classes of the assets have specific rate so that this rate will be the same. Good. Now over here, all what you want to do is just calculate the capital allowance and multiply it by the tax rate. And capital allowance simple means taxman's depreciation. So if you want to get the taxman depreciation, get the depreciation and multiply by the tax rate. You are done. So capital allowance simple means taxman's depreciation. Good. How do you get the capital allowance? They will tell you how the tax authority will depreciate the assets. Please, here, if they inform you the company's method of depreciation, please boycott it. Ignore. They are going to give you two items: the company's method of depreciation and the tax authority's method of the capital allowance. Please boycott the company's own and use the tax authority's own. Let me give you a clear example here. In this question, they said that although one of the notes or the paragraph stated that although could, yes, it's a reason where I've highlighted. It's not coming though. My highlight is not coming though. Although this production machine is expected to have a useful life up to what, 10 years. So to the company, the machine will last for 10 years. Government legislation allows Ajasco to claim the capital cost of the machine against the manufacture of single product. And then it went further to say that capital allowance will therefore be claimed on straight line basis over 4 years. Good. So that is it. Now coming here, the company said that the machine will last for 10 years. But the capital allowance will be claimed over what? 4 years. We have to use the tax authorities, not the company's rule. So here, just calculate your depreciation and multiply it by the tax rate. You are done. So let's see here. So we are doing the workings. Okay, probably let me do it here. I guess here is a very big place. So workings. So I'll put my year. I'll put my capital allowance. That's the same as what? Taxman's depreciation. And here's the tax saved. Now, there are two methods, whether straight line or reducing, and then any other. The third method is discretionary. I can tell, okay, 50% in the first year and 50% in the next year. That's it. Now, how are you going to calculate depreciation? Over 4 years. So year 1, year 2, year 3, year 4. They are using which method? Straight line. So straight line, what's the cost of the machine? The cost of the machine is 800,000. So depreciation will be 800,000 divided by 4 for the first year. If they don't give you the years, they'll give you rates, maybe 25%. So 800 divided by 4 will probably give us 200. And we know that for straight line, depreciation charge will be the same over the asset life, right? Good. And here it means that the capital allowance will be the same. So year 2, the same 200, the same 200, the same what? 200. So to be 200 over the 4-year period. Good. What about the tax save? We said the tax save is equal to the capital allowance times the tax rate. What's the tax rate in the question? It's 30%, and that will probably give us 60 Ghana cedis. So 60 cedis. So it's going to be 60 throughout. In fact, the truth of the matter is that if you are using straight line method, you don't need to do all the years. Just calculate just one because it's going to be the same throughout. Good. So for straight line, that is it. Calculate your capital allowance, the same as depreciation. Multiply by the tax rate to get what? The tax saved. So this is the tax saved. And we have to add it. Yes. Because out of the tax, what's the tax expense? Tax of 237. They will subtract 60 from it. Yes, so that's why we are adding it back. It's a plus for us. So that's why we are adding it back before we will pay the net of it. Good. So I'll take it off and then we are done. So tax saved on capital allowance will be 60 and show the working. So tax saved on CA, capital allowance. If I can show the working here, that will be 800 divided by 4 times what? 30%. That's the 60. Good. And it will give us 60. Please, if you pay tax 1 year in arrears, the enjoyment, you have to enjoy it 1 year in arrears, so you can't claim it in the same year. The pattern of your tax payment should correspond what? The pattern of what? The payment of the capital allowance. So 60, 60, 60, 60. So the question is, assuming this question is a reducing balance, that's your question in advance. You are going to solve it again using reducing balance. And I hope everyone can do that. How to calculate depreciation using what? Reducing balance. Or how to calculate capital allowance using reducing balance method. So that's the capital allowance or tax save on capital allowance. Good. We are done. Is there any disposal? Are they going to sell this machine after the end of the asset life? Are they going to sell the machine? No. There's no disposal value here. Is there any working capital? No, there's no working capital. So have you seen that they've not accessed all the items? Few of them. Good. Now what again? Is there any cost of investment? Yes, there's cost of investment. Let's bring the cost of investment. What's the cost of investment or investment? Can just put it because of space. It should be at the year zero. So investment, year zero. The cost of investment is 800. Put it in brackets. Dash, 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 dash. Because they didn't probably inform us that this 800,000 will be paid, maybe 50% will be paid now and 50% later. No. So that is it. Now let's go to the question and see if we have exhausted all the items in the question to avoid oversight. Good. But the question was a bit straightforward. Aside the issue created, yes, I guess we've used all of them. So we can now go ahead. Cost of capital is 10%. Then can go ahead and finish the question. Good. Now let's see. Now let's sum all up. Sum them up, sum them up, sum them up. So this is what you call net cash flow. Net what? Cash flow. So the cash flow that you see in the questions, this is how you got them. Now please sum them up. 800 negative. Year 1, 2, 3. What do you get? Kindly give me some of the answers. Fast to finish fast. Let's 30.8 plus 60. 85.2. So year 4 will be 85.2. 85.2. Agreed. Okay. Why is the camera taking the picture down? Why is the thing going down? So some of the thing is going down. Okay, some of the thing is going down. Okay. Wow. Thing is going down. This is the camera. Probably. No, this one is not a camera. It's the hand. The hand is suffering from what? Opomiasis. Yes. Good. Yes, so I think this one is a bit okay. Yes. So I'm write it here. 85.2, right? Please, if your own is ready, let me have it. 85.2. Good. But this one is only. Year 2 is what? Year 2 is 187.4. 187.4. And year 3 is 127.2. 127.2. And then year 4 have it. Year 1 is not there. The one is not there. So kindly get me the year 1. Okay, so year 1 will be 790 plus 237 plus 60. Good. That's 613. Agreed. Well, I like that. 613. Fat good. Now we are done with the net cash flow. What next? Discount factor. What is the discount factor? The cost of capital is at 10%. So calculate the cost of capital for me, which at 10% will be 1 over 1.1. If I'm in year 1, 1 plus 0.1. If I'm in year 1, put 1 there. Year 2, put 2 there, in that order. So kindly give me the discount factor. So year 1 will be, year 0 will be 1. Yes. Because 800 Ghana cedis today, the same as 800 Ghana cedis. It won't change value. Year 2 will be what? 0.909. Year 2 will be 0.826. 0. In fact, let me write it for you to see too. And under the multiplication will be issue. You can also confirm the figures. So year 1 will be 0.909. Let me step him down. Yes. We are done. And then 0.826 and then 0.751 and then 0.683. Is that so? Hey, these kind of factors. Please. Then you underline it and then we are done. So you get this one, present value, PV of cash flow. PV of what? Net cash flow. So here it still be 800,000. You are multiplying this by this. Then you are done. This by this. So can you give me the answers and then let's end the show. Yeah. So what do we get? Please, what do you get? Okay, let me do it there. Now let's see. 613 times 0.909. That will give us 557.22. Is that there? No, it's not there. So let me write it. 557.22. Then 187.4 times 0.826. 826. That will be 154.79. Then we will have 127.2 okay by 0.751. Please, can you give some of the answers and confirm for me? Yes. 95.53. Then 85.2 times what? 0.683. Good, I like that. That's 58.19. So 58.19. Now everybody should find the MPV for me. You are done. That's the end of the game. And that's the end of today's edition. So therefore, the NPV will be Ghana cedi of what? Negative 800 plus this, plus this, plus that in that order. Then you are done. So kindly do that and then let me have the figure. Just let me know when you are done. You can type it for me. In fact, everyone had the answer correct. 65.3. So can I write 65,730 Ghana cedis because you have raised your 3 zeros. So if you are getting 65.73, don't forget to multiply by 1,000 to get your full figure. So therefore, the MPV will be 65,730 Ghana cedis. So what will be the acceptance criteria? Should they have to accept the project or they have to what? Reject the project based on the financial viability? So should they accept or they should reject? I like your calculation. In fact, everybody had. They have to accept the project. Okay. Why? Why? Accept. I like that because it's a positive MPV. Okay. Because the MPV is what? Positive. Meaning that the shareholders' value will be increased. Shareholders' value will be increased. And then the project will increase the profitability level of the entity by 65,730. Good. MPV is positive. Yeah. Once MPV is positive, they should accept it. Good. We have some extreme circumstances. Or what if it was negative? Wow. They have to accept it or they have to reject it. If it's negative, reject it. Yes, if it's negative like this, you have to reject it. And sometimes too, the project may be negative, but they will still accept it. Why? Because that one, we even ask you to give us the circumstances or the factors to be considered before they will probably accept this project. The other factors, even though the project is still what negative, so even though the MPV is negative, they have to reject it. But considering other factors, the MPV is just a calculation, it's just a number, figures. Considering what? The qualitative aspect of the project. Probably that project will let you gain your best name. That project will make you proud, feel proud, but in fact, indeed you are spending more. Yes. So when happening that way, though the project is negative, you still have to accept it. Or customer loyalty, or contract. You've entered into a contract, binding contract with someone. Realize that no, this project will give me negative. To fulfill part of your obligation, you cannot abrogate the contract. Go on. So these are the few conditions. Good. This is how far the good Lord will bring us for today's edition of the class. Now, next meeting, we'll discuss the advantages and disadvantages of MPV. We call it the strengths and then the drawbacks of MPV. It's very topical issue. Now that you know how MPV look like, you can come out with what advantages and disadvantages of it. So we discuss that in our next lecture. So kindly follow that. And then what again? Yes, I'll probably project a work. I'll forward it to your mail. Yes, the assignment for today. I'll forward it to your mail. So this is the NPV. What level is the IRR, internal rate of return? And probably we are done with the investment appraisal. What level is what? Question solving. What level is question solving? Next week, tomorrow. Wow. Tomorrow I'll solve some of your past questions. Hoping that by then the notes will be ready. But the notes will be ready on Monday. Yes, that is the truth. The notes will be ready after Monday. Yeah. The notes will be ready probably after Monday. Because of the crash on the hard drive. Yeah, the hard drive got crashed. So I have to quickly call in for the questions. Yeah. So that is it. Thank you very much for coming. If you have any question, kindly ask before we officially end the class. Okay. So question time, understanding time. Please, still waiting for the note. I'll still forward you question to your mail. So expect your mail today around 3 to 4 there. I'll forward the question to your mail. Pick it up and then you do it for me. Yes. I'll forward the question to your mail and then the notes will be ready. So if you have any question, kindly ask and then we are done. Okay, if there's no question for me, then thank you. History of the day. History of the day. History of the day. History of the day. Gabadam. What is the largest dam in the world? The largest man-made dam. The largest man-made lake, not dam, lake, yeah. River Nile. That's river. This one is lake, right? Lake Nile. Okay. Man-made lake, Lake Bosumpi. I like that. Man-made lake. The largest one, Lake Bosumtwi. Wow, Lake now. It's Pascal around. He normally score this current affairs. Yes. Who tell me the largest man-made lake and what was the purpose of that lake? Yes. They are researching. Google is at work. Okay. So that's Lake. Yes, Pascal is around. Lake Kariba. Good. Lake Kariba. Okay, I have a question. The additional cost incurred, which has not been recorded, the cost already been added. It means that the cost has not been captured. That 30,000 wasn't captured. So they had their cash flow to be 90,000. So after capturing that one, it will reduce it to what, 60,000. Good. So that is it. It has not been recorded. So we have to record it, or it has not been included. It has not been included. It means that it has not been recorded. Though. Good. So that is it. Okay, back to the history of the day. Lake Kariba. Lake Kariba is by, how do you call it? By volume, the volume of it. Do you know that Lake Volta is also one of the biggest lake in the world? I like the Lake Volta. In fact, Lake Volta is the largest by surface. In terms of surface, Lake Volta is the largest lake, man-made lake in the world. Wow, Ghana too, we have history. Good. Then it covered 3.6% of the land surface of Ghana. So if you take our land, 3.6%, wow, and land lake is very, in fact, if you get some luxury time, just travel to Ghana and ask for the Volta Lake, then experience it. Please, after the coronavirus, so don't come after the coronavirus, please, don't step your foot here, other than that. You'll be crucified, yes. So, but the Lake Kariba, which is between Zambia and Zimbabwe, hey. Good. The timing of the cash flow is very important. It will be incurred in year 3, so it will be part of year 3's cash flow, but not the initial. The initial cost will be recorded in year 0. Good, so that is it. If you add it to initial cost, it means that it will be incurred in year 0, which wasn't so. Good. Back to the issue of the day. We like the history. Yes. In fact, most of these large lakes serve as a source of power, like dams. So Lake Kariba in Zimbabwe. So on it, they built the Kariba Dam. Yes. And then Lake Volta gave us the Akosombo Dam. Yes, Akosombo Dam. So that is it. So the largest man-made lake in the world, Ghana too, we have one by surface, 3.6% of the Ghana's. It is 8,500 square kilometer. 8,500. So it covers 8,500 square kilometer. That's the Akosombo Dam. But the Kariba Dam, that one is 5,800. Wow, what is the reverse? 5,800. So by surface, we have beaten it. But in depth, no, in depth, Kariba is 180. Akosombo, no, Lake Volta is around 150. So in terms of depth, it took over 180 trillion. If I should write it on the board, in fact, to be now the history for next week. Tell us how dams and then lakes are constructed. Good. So with the source of water, where they get the water to fill the dam or the lake? Tell us. That's the history for next. Good. It's 180, comma 1, 2, 3, comma 1, 2, 3, comma 1, 2, 3. Comma 1, 2, 3. Yes. Is that so? Good. That's the depth of the Lake Kariba. Good. So that's the issue of the day. So we are done. Thank you very much for coming. Have a nice day. And please don't forget to watch the remaining videos, the part 2, part 1. Yes, I'll link the cost, calculation of cost to the YouTube description section, the video description section. Right, you will tap on it, it will lead you there. And then also tomorrow we'll be solving one past question. Tomorrow. Then what again? Yes, and kindly subscribe. Yes, kindly subscribe. Yes, just click on the subscription button and then the notification button too as well. Turn on the notification button so that when there's any video, you will see the notification, because sometimes I'm unable to forward the link to all of you. So you get a notification, then you probably get it. Most of your videos are there. Good. And don't forget that there will be premiere next week, Monday. Yes. Monday, from Monday going, there will be premiere on the standards, financial reporting standard, all the standards from the IASs to the IFRSs. So that we are starting from the IAS. So don't forget that when you go there, you can get it and then you have a look, or you probably watch it to get it. Good. Good, so that is it. History of the day. And we are done with the history of the day. The largest man-made lake in the world. If you have anyone again. Next week's own is how lakes have been created. And then the source of water. So which water they use to fill the lake? Yes. Hey, history of the day. Which president is the most wicked in the world? The wicked president in the world. Wow. Okay, we will talk about that. So thank you very much for coming. Have a nice day. Good day. Thank you very much for coming. I have to sign up for the next class. So goodbye. Have a nice day. Thank you, everyone. Don't forget to subscribe. Yes, do that.